Hey, what's up, everybody? It is Friday, December 13th. Friday the 13th. Oh, hey. All right, I haven't made a video in a couple of days. A lot of stuff going on. Whew. We had a Fed meeting this week. We had an ECB meeting. We had a trade deal, right? U.S. and China trade deal. Nobody seems to know exactly what it entails. I guess China's going to buy about 50 billion worth of U.S. agricultural products, and the U.S. is going to hold off on any further tariffs. I think there's going to be a reduction in some tariffs. We'll see. You had the UK general election yesterday. Big win for the Tories, so they have a majority, the biggest majority since Thatcher. So we'll probably see some movement on Brexit. You had a huge rally in the British pound yesterday, although it's given a good portion of that back today. The dollar's been weaker. So yeah, a lot going on. And the Fed announced yesterday a significant expansion in its liquidity provisions. Look, I want to talk about, let's start off with that. Let me start off with that. You know that this is one of my main focal points, these flows between Treasury or the Fed, let's say the consolidated financial arm of the government, and the economy, the banking system. So we have seen since September 11th a very significant increase. I think it's something like 240 billion increase, or almost 300 billion increase in reserve balances right now are at 1.67 trillion. That is the highest level in 9 months. You have to go back to March of this year to see a reserve level of that magnitude. You also have the Fed's Treasury holdings now up year over year. I think something like 40 billion up over last year. So that has seen a complete reversal. Remember, since the end of 2017, the Fed had been reducing the size of its balance sheet, divesting itself of assets, allowing assets to roll off, and we got down, I guess, with Treasury holdings probably close to, I don't know, several hundred billion, 300 billion below the previous year, but now it's up. Let me talk about reserve balances, because as you know, I have been using this, or these are very instructive in telling us when the system gets overloaded with reserves. It triggers the banks to have to make adjustments in their asset holdings because of that supplementary reserve leverage ratio, right? That's tier 1 bank capital divided by consolidated assets, of which reserves are part of consolidated assets. So when reserves build up, the denominator in that equation goes up and it shrinks the leverage ratio, and that's no good. So yes, we have had a significant buildup in reserve. And by the way, when it shrinks the leverage ratio, what does that mean? Banks either have to A, raise more capital, or B, they have to sell off some assets to stay in compliance with that ratio. And a lot of banks internally, by the way, the ratio is 3%, but a lot of banks internally like to keep that up around 6%. So they're over protected because they want to make sure they pass all the stress tests and all this other stuff. So that's been a big increase in reserves. So what has happened? Well, you also have to look at, or what I look at, is the ratio of reserves to deposits, right? Because that has to be at 10%. That's the minimum threshold, 10% reserves to deposits. Now it fluctuates. It fluctuates from a low of 10%. And really, what caused this whole crisis? That's a good question, and that's a question that's been asked in the media, and nobody has given a sufficient or a correct answer as far as I'm concerned, so I'm going to give you the answer. The answer is, when the Fed was bringing reserve balances down in that period, culminating where they got very, very low in September, it actually, reserve balances for a very brief time went below that 10% threshold to deposits. So it essentially threw the system into default. In other words, there weren't enough reserves to go around. And even if it was at 10%, you have to understand something, that reserves are not distributed equally. The big banks hold the vast majority of reserves. So the smaller banks, they had to go out and borrow reserves, and that's what spiked up the overnight lending rate, and that's the Fed's policy rate, so it had to step in. Now, there's a bunch of reasons for this. Number one was that Fed bringing reserves down. Somebody was asleep at the wheel. They brought them down too low. The other thing was it's tied in with the debt ceiling. Remember, the Treasury was not able to issue new debt, and then when Congress suspended the debt ceiling at the end of July, Treasury had to make up for all these debt sales that didn't happen as a result of the debt ceiling. So there's been a massive amount, and this really got going in the new fiscal year starting in October. Huge amounts of Treasury sales. We are now up over 450 billion in Treasury sales over where we were last year. So Treasury sales are an enormous drain on reserves. So you had this massive reserve drain going on in the form of Treasury sales. Prior to that, you had the Fed draining reserves. The whole system was thrown basically into default, and overnight rates spiked. Now, why is this still going on? Why is the Fed adding? I can say, number one, you still have this massive volume of Treasury sales happening on an ongoing basis. And number two, the Fed is, I think it's overshooting its target. Now, an interesting ratio is what I talked about earlier, the reserves to deposits, right? I said it has to be around 10%. It's been as low as 10%. It's been as high as 14% this year, 13.8, 13.9. It's currently around 12.6%. And I can tell you when it got up to 13.8, 13.9 in March, what happened? We had a big correction in the stock market. So, right now, what's been going on is the Fed has been stabilizing the system with its liquidity provisions. But now we're starting to get within that threshold, right? We're 12.6% reserves to deposits. If we get back up around that 13.8, which definitely could happen given now the Fed's announcement of a significant boost to its liquidity provisions by the end of the year, we could have some turbulence in the stock market. Bigger picture, fiscal support is historic, so the economy is going to be fine. This trade agreement, I think, lifts some of the headline risk out of the market now, which is a good thing, right? So, big picture still looks good, but technically, the monetary structure, I guess, monetary conditions, looking out towards the end of the year with what the Fed plans on doing, I think it gets a little dicey. Okay, a little bit cautious on oil up here at 60 bucks. Commercials have been sellers up in this range, consistent sellers. Gold commercials have been selling in 1480 to 1485 level. They've been buyers down around the 1450, 1460, 1445. By the way, commercials in oil have been buyers at the 56 to 55 handle. Would love to see a pullback there. Anyway, all of this stuff, as usual, in my report. Nobody covers this sort of information. I'm the only one who has an applied approach to MMT. Remember, January 1st of 2020, the subscription rate goes up to $395 a month. It is currently $250. Go to my website, pitbulleconomics.com, and sign up. for a 30-day free trial. Lock in your rate. Lock in the $250 a month rate right now. Nobody does what I do. Nobody provides this information and the mental game that goes along with it. Have a great weekend, everybody. See you next week. Bye-bye.